Look, let's just start here. We're getting very close to one of those moments in the market that most people won't notice until it's too late. And I don't mean a sudden price spike or some dramatic headline flashing across financial news. I mean something deeper, something structural, because right now the silver market is showing stress, not in the way people expect, but in the way systems usually behave right before they begin to break. So let me slow this down and walk you through it in a simple way. Right now, we're approaching what's called a delivery window in the futures market. And if you're new to this, don't worry about the terminology. It's actually much simpler than it sounds. A futures contract is basically a promise, not actual metal, just a promise that at some point you can ask for real silver. Now, here's where things start to get interesting, because most people never actually ask for the metal. They just trade the promise back and forth again and again. It's almost like people trading restaurant reservations instead of actually going to eat the food. But every once in a while, people show up and say, no, I don't want the reservation anymore. I want the actual meal. And that's what's called standing for delivery. And that's the moment when the system actually gets tested. Now, here's the tension we're dealing with. There are hundreds of millions of ounces worth of paper claims floating around right now, but the amount of silver that is actually sitting there ready to be delivered is only a fraction of that. And that gap, that difference between what's promised and what actually exists, that's where everything starts to matter. Think about it like a bank where everyone has money on paper. Everything looks fine, balances look healthy, statements look normal. But if too many people show up at once and say, give me my cash, that's when reality hits. And that's exactly the kind of dynamic we're watching in silver. Now, I'm not saying there's going to be some dramatic overnight collapse. That's not how these things usually play out. What I'm saying is something more subtle, more controlled, but in many ways more dangerous, because instead of breaking quickly, this system is being drained slowly, and that's the part most people miss. They're waiting for fireworks, but the real story is erosion happening quietly in the background. Let me give you a clearer picture. Even if a small percentage of contract holders decide they actually want physical delivery, we're still talking about tens of millions of ounces. And when the available supply is already tight, that's not a small request. That's real pressure. So what does the system do when pressure builds? It adapts, not by breaking immediately, but by changing behavior. You start to see incentives show up, higher premiums, cash settlement offers, encouragement to roll contracts forward instead of taking delivery. It's basically the system saying, maybe you don't actually need the metal, let's just settle this another way. And that works for a while until it doesn't, because at the end of the day, a paper market only works as long as people are willing to accept paper. The moment they prefer the real thing, everything changes. Now, let's zoom out a bit, because this isn't just about contracts and delivery mechanics. There's a global layer to this story as well. Right now, there's a noticeable difference between silver prices in Western markets and silver prices in Eastern markets. And this isn't some tiny gap, it's a meaningful premium. And what that means is that in one part of the world, silver is being valued more highly than in another. And markets don't ignore that, they respond to it. So what happens next is simple. Metal starts to move from where it's cheaper to where it's more valuable. Basic arbitrage, buy low, sell high. But here's the catch. When physical metal starts leaving one region consistently, it doesn't just affect price, it affects availability. And that's exactly what we're seeing right now. A slow pull, a steady migration of real physical silver moving towards stronger demand. And again, this isn't loud, it's quiet, it's methodical, but over time it adds up in a very real way. Now, here's where things get even more interesting, because while all of this is happening in the background, most retail investors are focused somewhere else entirely. They're chasing tech stocks, they're chasing hype, they're chasing whatever's moving fast right now. And look, that's not to say those markets don't matter, they do. But while everyone is looking up there, something important is shifting underneath the surface. Because silver, historically, has always been more than just a commodity. It's been a signal. It reflects stress in the system. It reflects demand for real assets. And it reflects trust or lack of trust in financial structures. And right now, that reflection is starting to look very different. Let's talk about behavior for a second, because behavior often tells you more than headlines ever will.
Large players, institutions, long-term holders, they're not reacting emotionally. They're acting strategically, and what we've seen over time is a consistent pattern of accumulation. Not aggressively, not all at once, but steadily. Almost like they're aware of something that the average market participant isn't paying attention to. And that brings up an important question. Why would anyone consistently choose physical delivery instead of just trading paper unless they believed that physical ownership actually matters? That's not a casual decision, that's a deliberate one. Now, I want to address something because a lot of people hear discussions like this and immediately think, okay, so price is about to explode. But that's not necessarily how this works. That's actually the trap, because price is usually the last thing to move. Structure moves first. And what we're seeing right now is structural tension building underneath the surface, the kind of tension that builds quietly and doesn't make headlines until it finally does. Another signal worth paying attention to here is something called backwardation, which is when the current price of a commodity is higher than its future price. And under normal conditions, that doesn't really make sense, because future prices usually include storage, time, and cost, so they should be higher. But when the present becomes more valuable than the future, the market is sending a very specific message. It's saying, I want it now. And when a market starts saying that consistently, that's not noise, that's urgency. And urgency in a physical market is not something you want to ignore. Now take a step back and look at all of this together. Paper claims far exceeding physical supply, rising incentives to avoid delivery, metal flowing from west to east, persistent premiums in physical markets, and signs of immediate demand pressure. Individually, you could dismiss each of these as noise, but together they form a pattern, and patterns are where real insight lives. Now here's the part that doesn't get said often enough. The modern financial system is built heavily on trust. Trust in currency, trust in contracts, trust in counterparties. And for the most part, that trust holds. But when crocs start to appear, they don't show up as sudden collapse. They show up as subtle preference shifts. People quietly deciding they would rather hold the real thing. And when enough people make that decision, you don't need panic, you get transition. And that's what this feels like right now. Not chaos, but transition. From paper dominance to physical relevance. Does that mean everything changes tomorrow? No, but it does mean something important is already changing beneath the surface. And the people who recognize it early are the ones who position themselves differently. Not emotionally, not reactively, but intentionally. Because at the end of the day, this isn't about predicting some dramatic event. It's about understanding pressure, incentives, and behavior. And right now, all three are pointing in the same direction. So the real question isn't whether something is happening. The real question is whether you're paying attention to it. Because markets don't usually send clear invitations. They send signals. And silver right now is sending one of the clearest signals we've seen in a long time. Not loud, not explosive, but undeniable if you know where to look. And over the next few days, as we move closer to key delivery timelines, that signal is either going to fade or it's going to become a lot harder to ignore. But either way, this is one of those moments worth watching closely, because sometimes the biggest shifts in the market don't start with noise. They start with a quiet imbalance that slowly becomes impossible to ignore. And that's exactly where we are right now. If you've been trying to understand markets like this without all the noise and confusion, I've put together something simple that breaks it down in a practical way. No hype, no complicated jargon, just clear thinking and real strategies. You can check it out in the description if you're interested. And just remember this, watch the flow of metal, not just the price, because price can lie for a while, but flow never does.